COMEX registered silver just pressed toward 120 million ounces. That's not a statistic. That's a countdown. Most people won't notice until delivery terms change, premiums decouple, or access just disappears. By then, it's not early anymore. It's expensive or closed. Right now, this week, delivery volume is unusually heavy. Paper selling pressure looks relentless. The headline price, calm, almost boring. But underneath, the physical system is grinding. Dealers are tightening terms quietly. Premiums won't budge. Registered inventories aren't restocking after big delivery months. And a few dominant banks, J.P. Morgan Chase, Citibank, still hold concentrated short exposure that makes no sense unless you understand the game. If you're stacking, hedging, or just trying to protect purchasing power in a world where dollars buy less every quarter, this matters. We're not early. We're just paying attention. Your job isn't to predict when this breaks. Your job is to recognize the structure so you're not surprised when it does. I'm going to show you two patterns that repeat every time physical meets leverage. You'll see them again. And I'm giving you 5 signals to track this week, not someday, this week, so you know what stress looks like before the headline catches up. We track this together. Hit subscribe. We're building a group that watches flows, not narratives. Registered silver at COMEX sits around 120 million ounces, maybe a touch higher, maybe slipping lower, depending on the day. That number matters because it represents the physical metal actually available for delivery against futures contracts. There's another category, eligible. That's metal sitting in the warehouse, but not tagged for delivery. It could convert to registered if the owner agrees, but it doesn't have to. When registered falls while delivery volume stays heavy, that's stress, and it's been falling. We've seen repeated large delivery months, March, May, July, without meaningful restocking. The valve isn't refilling, contracts are clearing, metal's moving out, and what's coming back in isn't keeping pace. Meanwhile, the price chart, flat, controlled, calm. That's the hidden layer most people miss. They think a shortage shows up as a price spike. It doesn't, not first. First, it shows up as infrastructure strain. Lease rates start whispering, premiums get sticky, delivery timelines stretch, and the narrative shifts. Suddenly, everyone's talking about mining stocks and ETFs while physical quietly drains. Here's where most smart people get trapped. They watch the price. They wait for confirmation. They assume the market will announce itself. But shortages whisper before they scream. Think of the physical silver market like a boiler under pressure. When registered inventories fall and delivery demand rises, that's heat building, pressure increasing. The system doesn't explode immediately. It can't. There's too much at stake. Margin calls, settlement risk, institutional credibility. So instead, someone opens a valve. That valve is paper supply. More contracts get written. More liquidity floods in. Sell pressure appears right when you'd expect buying to dominate. It looks stable. It feels managed. And it is managed. Because letting pressure build unchecked would force a reckoning nobody in the current structure wants. This buys time. It works until it doesn't. Every commodity that trades both physically and on paper eventually hits this moment. The paper market is infinite. The physical market is finite. When demand for physical converges with the limits of available supply, the paper side has to either deliver or acknowledge it can't. Historically, that acknowledgement doesn't come as an announcement. It comes as a rule change, a margin hike, a shift to cash settlement language, a temporary adjustment. The 1980s silver spike ended with margin changes and position limits. The nickel squeeze in 2022? Trades got canceled. London Metal Exchange literally rewound the market. Palladium in 2000, 2001, lease rates spiked, deliveries stalled, and the price eventually ran, but only after months of nothing's wrong commentary. The playbook doesn't change. Only the names and dates. Right now, we're in the valve phase. Paper is flowing. Selling pressure is consistent. The price looks boring. But the registered inventory number keeps ticking down, not telling you to panic, showing you what to watch. The valve works until the physical side can't keep pace. Then the mechanisms change, and the people watching flows instead of headlines are the ones who don't get caught flat. Price isn't the first signal. Access is. Before a commodity runs, it disappears. Not everywhere, not all at once, but selectively. Retail premiums decouple from spot. You see $2 to $3 over, then $4, then $6, and the spot price barely moves. Delivery timelines stretch from 2 weeks to 4, then 6. Minimum order sizes increase. Dealers start saying, call for availability instead of posting inventory online. This is rationing. It's how physical markets manage scarcity without admitting scarcity. If you're a dealer and you know restocking is getting harder, you don't drop prices to move inventory. You raise premiums, slow down sales, and wait. If you're a wholesale supplier and lease rates are spiking, you don't flood the market. You tighten terms and prioritize relationships. Meanwhile, the futures price, set by contracts, not metal, stays calm. Because the contracts don't care about delivery. Most of them settle in cash or roll forward. The system assumes physical is available, until it isn't. This is why shortages look boring, right before they don't. The crowd watches price. Price is lagging data. By the time price moves, access is already gone for regular participants. The professionals aren't buying at the top. They positioned during the rationing phase, when premiums were rising, but the narrative was still nothing to see here. Think back to early 2020. Gold and silver premiums started climbing in February. Spot was still under $16 for silver, under $1,600 for gold. But try getting a monster box without a weight. Try sourcing 1,000-ounce bars at spot plus normal handling. You couldn't. Mints slowed. Dealers sold out. Premiums hit 30 to 40% over spot on retail products. And the futures price stayed pinned until late summer. The people who recognized the rationing phase got in early. The people who waited for the chart to confirm paid double. Could this reverse tomorrow? Absolutely. A wave of scrap could hit. Registered could refill. Delivery volume could drop. But the pattern is recognizable. And right now the signs point toward stress, not ease. Everyone's asking the wrong question. They're asking, when will silver hit 40, 50? The real question is, what happens if one delivery month doesn't clear cleanly? Think about the leverage in this system. Every ounce of registered silverbacks, multiple claims. Futures contracts, options, ETF shares, allocated accounts, leveraged bets, all assume that when someone wants physical, physical is there. But what if it isn't? Not all at once, just not enough, not fast enough. What happens when a major institution demands delivery in the warehouse, says, we need a few extra days, or we can offer cash settlement at current price plus a small premium? What happens when the exchange changes the rules mid-game, just like with nickel? You think the headline will warn you? It won't. The warning is happening now. In the inventory data, in the delivery volume, in the premiums that refuse to fall even while paper sells. Watch what changes first, not price, access, terms, language. Those tell you where the system is straining before the chart does. There are three broad paths from here. First, an orderly squeeze. Premiums keep rising. Registered keeps falling, but no rules change, no delivery failures. Just a slow grind where physical gets expensive while paper stays suppressed. Physical holders benefit on premiums, not spot. Paper traders get chopped. Second, a rule response. Registered hits a threshold and margins change, settlement language shifts, or position limits get enforced. Price may spike briefly, then get capped. Physical premiums stay elevated. The system protects itself. Third, dislocation. Something breaks, a delivery default, a major short covers, a shock sends institutions scrambling for metal. Spot gaps up fast, premiums explode, access vanishes. You can't know which path in advance, but you can know the structure. Here's what I'm watching this week. COMEX registered silver daily. Falling or flat during heavy delivery is stress. Dealer premiums versus spot. Sticky premiums during flat or falling spot is rationing. Delivery notices versus open interest. Persistent delivery demand drains warehouses. Lease rates and wholesale chatter. Rising noise means tightening metal. And any change in rule language? That one flips fast. Access disappears before price explodes. If you see delays, premium spikes, and rule changes clustering together, that's the transition from rationing to dislocation. I don't put all my eggs in one basket. I don't bet the farm on timing. Physical silver is a core position for me, not trading it. Held outside the system, I keep dry powder for optionality. I'm very clear on the difference between paper proxies and metal. My horizon is months to years, not days. And I diversify across failure modes, not just assets. If you're trading, respect volatility and rule risk. If you're holding, accept patience. Your risk tolerance isn't mine. Your timeline isn't mine. But if you're watching these signals and thinking in scenarios instead of predictions, you're already ahead. Most people wait for mainstream confirmation. By then, the physical is gone. The premiums are parabolic, or the rules have changed. You're here because you're not most people. You're watching inventories tick down during heavy delivery. You're seeing premiums that won't compress. You're noticing the quiet, the too calm price action while the structure underneath strains. That's the edge. Not a crystal ball, just awareness. What signal are you watching closest this week? Registered inventory, premiums, lease rates? Drop it in the comments. If you've already seen access tighten, longer waits, higher minimums, share that too. Real-world data beats theory every time. Make sure you're subscribed. We're tracking this live, and the next few months could get interesting fast. Bottom line, shortages whisper before they scream. Paper expands when physical contracts. Access disappears before price explodes. You don't need to predict the exact day this breaks. You just need to recognize the pattern while it's forming. We're in the valve phase. How long it lasts, nobody knows. But the inventory levels, delivery volume, and premium stickiness aren't random. They're the market telling you something. Your job is to listen.